Good morning, ladies and gentlemen. Glad you could all join us this morning on this lovely day in Tucson, Arizona. Wish we could be broadcasting from outside. It's just one of those wonderful days here in Tucson. Again, thank you to all of you who have chosen to join us this morning. Not sure if all of you were with us last week on our income statement presentation. If you were, welcome back. If you were not, no problem. Thanks for joining us. We will cover not necessarily similar topics. We're going to use similar businesses. So if you were with us last week, some of those things might appear a little familiar to you. I am Lori Simmons. I am on the lending team here at Community Investment Corporation. Again, I want to welcome you today. Thanks for joining us. We will be recording this session today. So for you or anyone else who wants to go back and reference some of the things we discussed today, you are more than welcome to do so. We may have people joining us throughout the presentation. We might start to see some comments come in on the right-hand side. Feel free to comment in our chat as we go today. But if you don't mind, I'm going to just pause for a moment here so I can share my screen, and we're just going to dig right in. All right, thank you guys so much for your patience as I got the presentation up here. So as I mentioned, we are talking today about the balance sheet. As I mentioned, my name's Lori Simmons. I will be instructing most of the class today. In front of you, you will see pictures of some other folks who are going to be joining us as well. Danny Nee, our executive director, will be popping in and out of the presentation a few times today. And we hope that Betty Vinal, our business manager and an independent bookkeeper here in Tucson, can also join us. Again, we do expect these people to be popping in and out of the presentation. If we have questions, we're going to show you how to ask them questions. We'll make sure and address them at some point in time throughout the presentation. Did want to share just a little bit more about myself. I am also a small business owner, just like many of you are. Oh, good. Danny's here. Thanks, Danny. Appreciate you commenting in the chat for us. Again, I am a small business owner here in Tucson. So as we go through all these different exercises, I just want you to understand I can relate. I have been through many of these activities myself. And to be brutally honest, some of them I haven't. But as we go through these lessons today, I'm going to try to relate them in my mind into my own business, which is what I'm hoping you will do as well. Oh, I just saw that Danny added a comment. Betty's not going to be able to join us today. Her daughter is in the hospital. We wish her all the best, a speedy recovery. So sorry to hear that. But Danny, it looks like this is all going to fall on you. So maybe we'll get some really tough questions. Maybe we should play Stump the CEO today, right? Just kidding. I don't think we've ever been able to stump Danny, but let's move on. I just want to share with each of you a little bit about Community Investment Corporation. We are a financial empowerment nonprofit organization. We believe that we give the members of our community who might be left behind or shut out of opportunities, we give them access to knowledge and financing to pursue new opportunities. At CIC, we know your worth. While the system may not recognize your value, we surely do. At the bottom of this slide, you see our website. We do encourage you to visit our website. We have a ton of resources on there. And I guess I forgot to mention, speaking of resources and website, we do have one of our staff members, our Chief Operating Officer, Caroline Nelson, who is in the background with us. So you'll see some comments come in, you'll see some links come in. That's going to be Caroline helping us out in the background. So Caroline, we thank you for helping us. Oh, there she is. She says, hello all, and thanks for joining. So that's Caroline in the background helping us. I'd like today to start out by getting to know each of you a little bit. Let's maybe start out by teaching you about the polling feature. So if you don't mind, Caroline, down at the bottom of our screen, we should have some polls in there. And if you can enable and unhide that first poll for us, so those of you joining us down at the bottom, you'll see poll and it says number 1. So if you don't mind just clicking on that poll, it's going to say, what type of business do you want to run? A for-profit, a nonprofit, or other? And if you don't mind in that poll giving us your vote. So I can see that we do have a member here today representing nonprofit. And then it looks like most of the participants are for-profit, but we will try and address some of the issues for whoever is with us today representing nonprofits. So we thank you for that. So obviously you all figured out the poll feature. And Carolina, if you don't mind, we'd like to know one more thing. How long have you been in business? Those of you who are participating with us today. Are you just starting? Have you been in business for 0 to 2 years or 2+ years? So again, you just saw that poll populate. If you click on the white part where it says poll and tell us, how long have you been in business? All right, so far it looks like we have a really good distribution here. We have some people who are just starting. We have some other people who have been in business 0 to 2 years. And then we've got some people who have also been in business for over 2 years. So thank you all for sharing that information. I think it's really important that we see we've got a very good distribution of folks here today. So for those of you who have been in business for 0 to 2 years, or those of you over 2 years, I would love it as we go through the chats or as we're asking questions today, if you can share some of your experiences, because I think we can all learn from each other. So let's talk a little bit about what we hope to accomplish today. One of the things we're going to hope to share with you is understanding the concept of net worth, whether that be in general or applying to your own business. We'd like you to gain some familiarity with the balance sheet, not only being able to read someone else's balance sheet, but hopefully eventually be able to prepare, even if it's a simple one, your own balance sheet. We want to understand the differences between assets and liabilities, potentially determine what your business is worth. And then lastly, we would like to understand the balance sheet as a whole and potentially how it might apply to financing if anyone is looking for a loan. So I have to be honest, most new business owners have no idea what their business is actually worth. And there's a cool little tool to help you determine what your business is worth. It's called a balance sheet, the reason we're all here today. So the balance sheet is actually a financial statement that analyzes all of your assets and liabilities. But in doing so, it also looks at the profit that you've made in previous years, what you've done with that money, whether you've left it in the business, paid yourself, and also maybe what you've invested in the business. So after you do all that, it comes up with one number, the net worth of a business. I kind of like the term net worth. It's intuitive to me, but I have to be honest, you're going to see it presented a couple different ways. You're going to see the title of it as owner's equity. So whatever you're most comfortable with, net worth, owner's equity means the same thing. Now, we did have someone here who is running a nonprofit. For you, all day today, we're going to refer to this as the balance sheet, but I have to be honest, for you, it's probably going to be called a statement of financial position. Just another name for a balance sheet. It's a little longer, but in certain ways, it's a little more intuitive because it's basically telling you and anyone who looks at that statement what sort of financial state your business is in. So remember last week, we talked about a profit and loss, which covers a limited amount of time, a period of time. The balance sheet summarizes the business at a particular moment. So at whatever point in time you are preparing that statement, that's what we're going to see on the balance sheet. So let's get into a couple little definitions. Assets are a little easier to understand with net worth, so I'd like to start there. Let's start at the top. There's really two main sections of assets, and you can read the definition here, anything your company owns that is going to help you earn cash. And there's many different types of assets. We've got current assets and fixed assets. A building or real estate you might own, your vehicles, obviously both assets. Your inventory or raw materials that you use to make the product you sell. Equipment to make that product. Cash, woo, cash is king. We like that one. Accounts receivable. Tools, might take you some types of tools to be able to make your product. And then furniture and fixtures. That one confuses people sometimes. What does that fixture mean? Obviously furniture, you're probably sitting on a chair, you're sitting at a desk. Fixture might be something affixed to the building that you need to do your business. That's really all that word fixtures means. So more complex companies are going to have a lot more categories of their assets. Others will have less. But if you think, so there's examples here. We're going to go to this in a few minutes and we're going to talk about which might be current assets and which might be fixed assets. But in the meantime, let's move on to the next section of the balance sheet, which is called liabilities. Obligations of a company that are going to cost it money. A lot of times liabilities are referred to as payables. So a couple examples here: accounts payable, taxes payable. I always cringe when I hear that. I don't know why. Of course, we all have to pay our fair share, but people think about taxes and we all cringe. Wages payable, the people who are working for you when you have to pay them. Loans and notes payable. As a lending institution and having worked for lenders for many years, that's an important one. We want to make sure that we all know how to pay our loans back. Customer prepayments. Oh, I apologize. I just saw the I just saw the comment from Danny about the nonprofit guy is me. So, okay. Well, thank you for that, Danny. We appreciate the clarification. So we're really going to focus more on profitable or for-profit entities today. I think Danny, as the CEO, has a pretty good handle on running the nonprofit. So thanks, Danny. I apologize I didn't see that comment sooner. So now we're going to do another quick survey of the room. And if you all don't mind participating, here we're going to use our Ask a Question feature. So down at the bottom, you see in white where it says Ask a Question. I would love to know, do you know the value of your business assets and liabilities? Now, before each of you answer, we understand each of you are in different places with your businesses. Some of you are small, some of you are just getting ready to start out. So when we ask questions, the goal is not to judge you or how you answer, but really just get information out there, helping people understand where they are. So as you answer this question, please feel safe giving honest answers. I think that's where we're going to get the most value. But again, if you click on the Ask a Question and then comment, do you know the value of your business assets and what about liabilities? So I apologize that I snuck out of the screen there. I had to answer that question myself. So for those of you participants, do you know the value of your business assets? And what about liabilities? So remember, an asset is either money your company has or will help you earn money. So it could be cash, accounts receivable, equipment. And then liabilities, things that you owe someone, a loan, a credit card, a debt, mortgage. And then let's move on to the next question under the Ask a Question section, which is, do you know the net worth of your business? So do you know how much your business is worth? I'm not asking you to give me a dollar amount here, but do you know how much your business is worth? I appreciate the honesty here. Most of us really don't know how much our business is worth. So I see a question here from Danny on what is accounts receivable. Great question. We will get to that, Danny. And then we have a comment from Robin. Well, it says, yes, I do. Oh, and no. Okay. So Robin is probably saying, do you know the value of your business assets or liabilities? She's saying yes, net worth, no. So again, appreciate all the honesty here. To be truthful, don't anybody feel bad about that, because for most people, we do not know the net worth. So, and the net worth of your business is going to be all of your assets minus all of your liabilities. So realistically, to figure this out, you need to fill out a balance sheet. But I mean, if someone was asking you this on the street, which obviously nobody's going to do that, but if they did, one way that you could think about it is, if I tried to sell my business, what would someone pay for it? So knowing all the things that I have, but also knowing how much I owe, that might give me an idea of what I might sell my business for. So let's go over the basic equation. Again, try and think about your business here, what items might apply for you, and that might help things make sense. So our very basic balance sheet equation is going to be assets minus liabilities equals net worth. And remember, we also called that owner's equity. And that makes sense, really. If you take everything you own and subtract what you owe, that should tell you the net worth or the net value of your business. So really, the full value of your assets minus your debts will give you the equity, the owner's equity, that you have in your business. So if you do a little algebra and move the equation around a little bit, it can be presented another way. And this might make a little more sense to some of you, so I'm going to present it that way as well. Your assets equal your liabilities plus your net worth. Again, we just moved that equal sign to a different side of the equation, but we're going to present today the balance sheet in a couple of these different formats, and I wanted you to see this equation in both cases, and you'll see with your business how this starts to make sense. So if you were with us last week, or maybe you attended the income statement presentation 6 months ago or 9 months ago when we did it last, we talked about our lemonade stand. So just want to review that little lemonade stand with you, because we covered most of this in the income statement, but let's go over that again. So what do we own on our lemonade stand? We have a bank account with $250 in it. We have inventory. We have some cups and napkins, items we're going to need to make our lemonade. We have this fancy looking mobile lemonade stand, which was worth $500. It's what we paid for it. Our assets are always going to start to be reported at what we paid for them. We have a juicer, so we can make our fresh squeezed lemonade quickly. So our total assets for this lemonade stand are $1,000. So now we have to look at the liabilities, because unfortunately, often there are some liabilities. And remember, liabilities are just the opposite of assets. It's money that we owe people, the obligations that are going to cost us money. So we have an account with our lemon supplier, and they give us 2 weeks to pay for those lemons. So that's why we have an account payable for $110. And one other liability we have from the last event we had, if you remember when we attended that in July, we've only paid one of our employees for that last event for $40. So we owe one of our employees $40. So our total liabilities for this company are $150. Pretty simple. Now, Danny's question was, what are our accounts receivable? Well, I don't see them on here yet. I just want to remind you we haven't forgotten about your question, Danny. We'll get there. This particular business does not have accounts receivable, and we'll share why. So let's take what we just had on that screen and let's build a balance sheet. So what did I tell you? We had total assets of $1,000 minus our liabilities of $150. So what should be the next figure? Remember, assets minus liabilities equals net worth. We have net worth of $850. So, hey, we just prepared a balance sheet. Pretty basic, pretty simple, but I want each of you to understand we can start simple and then we're going to get more granular as we learn more today. Now, again, for some of you who think about this a little differently, let's present it the other way with the other equation. Your assets of 1,000 equal your liabilities, what you owe people, plus your net worth. So again, this algebraic equation, if we start with an equation of 10 equals 10, and we add 1 to one side of the equal sign, we have to add 1 to the other side of the equal sign as well to get 11. Now, if we started with 11 plus 11, we wanted to get back to 10, we have to take 1 off of one side. Well, of course, we have to do that to the same on the other side of the equal sign. So we just want to make sure that both sides of the equal sign are balanced. Yes, balanced. That's where we get the term balance sheet. So just remember, we always want to have equal figures on either side of that equal sign. That's why we call it a balance sheet. Now, some people ask me, well, if owner's equity is just the difference between assets and liabilities, isn't it always going to be equal? Won't it always balance? Well, theoretically, yes, but the longer answer is that we kind of need to delve into that a little more. So we'll get there, I promise, but I want you to understand the basics about this equation. So again, I'm kind of stuck on this lemonade stand. Here we go. We have an opportunity for a free lemonade stand. We've had our little lemonade stand for a while, the pink one. And now we get the opportunity from 2 locals who are getting ready to retire. We have good relationships with both of them. They've offered to sell us both of their businesses for free. So we've got one cute little red lemonade stand. Their assets are $1,500. Here's another one. I love this cool van. A lemonade van is worth $30,000. So if we had the option to get both of these businesses for free, please in the chat tell me, which one would you take? The van for sure. I am with you on that, Caroline. I love that van. I think it's pretty sweet. Not only do I like the color, it looks really shiny. Yeah, I like it. I like that van as well. Okay, you knew there had to be a trick here, right, guys? So the answer is, it depends. Ah, Buck is taking the cart. Buck, are you just bucking the system here? Is that it? Or do you know something maybe that I don't know? Is there a particular reason, Buck? If you want to put something in the comment, I would love to know why you chose the cart. I'm going to go back to it. The cart versus the van. The value. Well, okay, it's only worth $1,500 and the van is worth $30,000. Maybe there are additional costs involved in the van. Oh, that's right. Oh yeah, gas, tires, more to maintain in the van, says Beatrice. Patty says the van's got too much maintenance. Yep, upkeep. Huh, interesting. See, I have to be honest, I was totally sold on the van when I first looked at it, but what this tells me is you guys are actually good business owners. You're thinking through a lot more things. So again, I was the one when I very first saw this, I was like, as I was going through this presentation that was written for me, I thought, well, of course I'm going to want that van. But I think you guys are pointing out some really good points here. We have to look at a lot more than just the value of that asset. So first of all, let's take a look. We've got some liabilities for $200 on the lemonade stand, the one that most of you guys decided you were going to go with. So the net worth of that red lemonade stand is $1,300. Not bad. It's positive. There's less liabilities than assets. Not a bad deal. Liabilities on that cool lemonade van are $35,000. So the net worth here is negative. So you guys were thinking about expenses to run the van, which I think are all very realistic because many of us are fortunate enough that we can own a vehicle. We know those things are expensive. What I'm focusing on here is the liabilities. So if they gave me the asset, but I only had $200 in liabilities on that lemonade stand, but I had $35,000 on the van, well, that van is no longer a good deal. So I think you guys were all along the right track. In this case, I was just focusing more on the liabilities. So I've got a little different scenario for you here. Now we have the option to purchase two lemonade businesses. At first glance, they have the same balance sheet. Both have assets of $50,000, liabilities of $40,000, and net worth of $10,000. Which one do you buy? This one's going to be harder to tell because as you can see, they're pretty similar size. One's got that major old lemon on top. I'm going to tell you, I'm drawn to bright, shiny things. I'm kind of leaning towards B. Somebody says they're going to go with A at that time. They like the cute window. Oh, with the cute little awning. I agree. That's kind of a cute one. Anybody else? From what you see here, do you know which one you want to buy? I'm going to argue and nobody's jumping in to answer. So I'm going to say nobody's really sure here because now you know, of course, I'm going to throw some curveballs at you. So let's start with assets. B, because Patty's going to sell popcorn. Man, Patty, I love that. I love that. And you know what? Popcorn makes you thirsty. So you're going to want to buy more lemonade. But I'm going to tell Patty, the reason I like that is it's 2020. What do we talk about with businesses in 2020? The buzzword has been pivot. How did you pivot? How did you change your business to adjust for COVID? And Patty added popcorn. So I like that, Patty. Thank you. And Robin likes A as well. All right, so let's get back to the presentation. Current and fixed assets. Buck's also going with A. So let's talk about the difference between our current assets. The definition of current assets is cash and anything you expect to turn to cash within 1 year. Now, fixed assets are going to be just the opposite. Items you purchase for long-term use, not likely to be converted into cash anytime soon, or they might have a useful life of more than a year. So let's give you a sample of some asset categories, which are current and which are fixed. Well, our cash, we know that is cash, so that's going to be current. And accounts receivable, here we go, Danny. What is accounts receivable? Accounts receivable is if you sell a product, but they do not pay you at the time that they receive your product or service, and now they owe you money. So you might ship your product somewhere. You might deliver it, but not collect a check. That person owes you money, and that item goes on your balance sheet as an account receivable. Does that make sense? And does that answer your question, Danny? Now, the reason it's a current asset is, my goodness, we better get paid on whatever we sold within a year. So that's why it's a current asset. Inventory the same way. Okay, good. Danny says we answered his question there. Thanks. So inventory. We sure hope that whatever you have in inventory, you're going to be able to convert to a product or a service within a year. That's why it's a current asset. Now, your fixed assets are the property, maybe the building, some equipment. If you have a vehicle, all of those items are going to be converted to cash in greater than 1 year. So let's do the same thing with liabilities. We want current And in this case, we don't call them fixed, we call them long-term. So current liability is a debt or obligation due within 1 year or a normal operating cycle. For this purpose, let's just talk about 1 year. For long-term liabilities, debts or obligations due more than a year from now. So let's look at some examples what that section of the balance sheet might look for you in your particular business. You've got accounts payable. So just the opposite, people that you owe money. Maybe you got some raw materials to make a product. Now you have to pay for that. And Patty asks, is 1 year common, Lori? It is. It is the most common, Patty, just because typically you're either going to have a fiscal year end, which might be June, depending on your industry. Most people are going to use a calendar year end of 12/31, but very rarely do I see current liabilities reflected of an operating cycle. It's typically just going to be converted to a year. So great question. Thanks. Again, just running through those different types of current liabilities. Current portion of long-term debt. That's one thing I very rarely see when people present financial statements to us, but I would really like each of you to think about this. If you have a loan and you owe money, this current portion of long-term debt is the principal only, because that's the portion that's going to actually add value to your asset. We don't include interest in there because interest is going to be an expense on your income statement. But let's say you owe $10,000 on a truck loan, or in this case, the van loan for your lemonade stand. And $5,000 of that payment is going to be due within the next 12 months. That is the current portion of your long-term debt. It's really important to a lender when they're looking at what are your obligations for your business to understand what do you have to pay within a year and what do you have more than a year to pay. So current portion of long-term debt is what's due within 12 months. Anything else is going to stay as your long-term debt. Now, long-term liabilities, we have deferred taxes, and the only reason for that is sometimes your tax liability can be spread out over multiple years, depending on your tax situation. I'm not going to get into details regarding that, but that's the only reason your income tax is payable as a short-term. Any portion that's deferred, and your accountant will always tell you what is deferred, might go into a long-term liability. So let's go back to our lemonade businesses. We know that these look exactly the same, at least here. Assets, liabilities, and net worth are both the same. But let's dig in and see where these businesses differ. So we've got our lemonade truck A. That was the cute one on the left that Caroline liked. It had the little awning on it. Here's the asset section of the balance sheet for that business. Then let's go over the liabilities for that same business. Accounts payable, there they show their current portion of debt, $5,000. That means that's what's owed this year, long-term debt. Okay, then we have the other truck that was on the right. That one had the big lemon on the top. That was the one that I liked. Here you can see their asset section and their liability section. Okay, many of you liked lemonade truck A. Now that you see this on the balance sheet, do you still agree you like lemonade truck A? And if so, give me a comment in the chat box why you still like lemonade truck A, or have you changed your mind? Are you now favoring purchasing lemonade truck B? Robin and Buck liked A. Patty liked B. Are you still favoring your decision? And if so, give me a comment in the chat box why. Okay, Caroline is sticking with A because they have more cash. Whew. I cannot disagree with that, Caroline. Cash is king. That's pretty important. And I'm looking at B. Is there anything that really offsets having that much cash? Well, that truck is worth a lot more. That big old lemon on top must be worth a lot. Your truck is worth $40,000. So that offsets a little bit of that. I'm not getting a lot of answers here. Oh, A has more accounts receivable. Oh, very good point. Yep, I agree with you there, Robin. A has more accounts receivable. So you've kind of hit on something there for me. I want to highlight the current assets and the current liabilities. So short term, remember we talked about 1 year. So all of the current assets and current liabilities are highlighted here. And now I'm going to put some totals in there for you and introduce a new concept called a current ratio. Our current assets on Lemonade Truck A are $20,000. The current liabilities are $15,000. So if we calculated a current ratio there, took $20,000 divided by $15,000, that equals 1.33. I like that. As a lender, I would love to see a business's current ratio over 1.0. So what that says is, how many times can a business cover their current liabilities with their current asset? Again, remember, those are easily convertible to cash within a year. And in this case, they have a big cash balance, as Caroline mentioned. So let's do the same for B. Total assets there, total current assets are $11,000. Total current liabilities are $15,000. Well, you divide that out. Now it's definitely less than 1, 0.73. So in this case, they do not have $1 of current assets to cover all the current liabilities. So for those of you leaning with A, I agree with you. For what we see here on this balance sheet, that cute little truck with the yellow awning is the way to go. Why? Because there's more cash, there's more accounts receivable. In essence, their current ratio is significantly stronger than B. So think about this with your own business. Can you cover your current liabilities more than 1 time with your current asset? If not, that's okay. We understand we're all at different points in our business, but that is one thing we want to get to, especially if we want to get to the point where we're going to borrow some money. So current ratio, hopefully maybe a new concept for some of you, or just a really good reminder for others. So in summary, Lemonade Business B has less current assets and more current liabilities. So I'm going to have to give up the cool truck with the awesome lemon on top and favor Business A. How about questions? Yeah, I like Patty's point too. And you do not have to sell anything with a lemon in it, and you can change your business product. So there she goes pivoting again. See, if I bought that truck with that big old lemon on the top, then I'm kind of stuck selling lemonade. I like that. How about other questions? Anybody else have questions about what we just talked about when we were looking at current assets or current liabilities? Now's your chance. Obviously, anytime you have a chance, but let's move on. Okay, so we're going to compare the same 2 lemonade stands and see how their balance sheets might tell different stories. So in this case, we're going back to the one with the yellow awning. Current assets are $20,000. Fixed assets are $30,000. We have total assets of $50,000. Total liabilities are $40,000. And that's what makes it up. Current liabilities and your long-term liabilities. So therefore, the net worth is $10,000. Again, the same for A and B. Do you know which one to buy based on this information? Well, you all know me now. You know where I'm headed with this. No, we really don't know which one to buy if these are going to show as identical here. So now what do we have to look at? We have to look at net worth. So I guess really to start is, well, what affects a business's net worth? There's a lot of different things that can increase or decrease a business's net worth. Do any of you guys have any ideas, any things you want to throw out there on what do you think affects a business's net worth? Think about your own business. What makes it more or less valuable if you had to sell it? Anybody have any ideas what affects a business's net worth? I'm getting crickets. So either people are typing or you're really not sure. And that's okay, because like I told you, assets and liabilities are much easier to follow than net worth. Thanks, Robin. I appreciate you jumping out there. How long you have been in business? Potentially. Could potentially affect net worth. Oh, sales. Okay. Potentially. Now, I think Robin and Caroline are thinking along the same lines here. We would like to assume that the longer you've been in business, the more sales or the more business you're going to have, more profit, correct? Robin and Caroline, I think that's where you're going with that. Oh, man, pandemic, Petty. Oh, real life. Here we go. Sure, it can absolutely affect your net worth. And I think you're all thinking along the same line. Robin, you're saying your client base. Beatrice is saying buying products and materials. So you guys aren't necessarily saying which increases or decreases, but I like all of your ideas. I mean, the first way that I think I would love to increase the net worth of my business is getting money from the magic money tree. Okay, sorry. I just had to throw that in there. I mean, we all dream. We all have dreams. And it's one of the things I dreamt about last night was a magic money tree. So that's why we threw that in there. But your business earns more profit. So I think, Robin, that's where you were going with how long you've been in business. We want to assume the longer we've been in business, the more money we're going to make, the more profit we will have earned, which I agree with you. And also, Robin, when you were saying your client base, if you have repeat customers, it should bring in more sales, as Caroline was saying, and potentially generate more profit. And I know that none of you input this, but I know you've all thought it because you're running your businesses and you're trying to figure out how to make things work. You could have people give you money or give things to the business. In most cases, it's going to be family, friends, investors of your business. So those are some of the ways that we can increase the net worth of our businesses. Let's think about, on the other side, how to decrease the net worth. Well, opposite of earning more money is losing money. And I'm going to kind of tie your comment into that, Beatrice, because I think if you are spending too much on buying your products and materials, you might lose money. Obviously, if we want to think positively, it would increase it if we're spending less. And then let's think about another thing is if you give away money or things. And that includes to you as an owner. So if you are paying yourself more than the net profit of the business, then it's actually going to decrease the net worth of your business. So just a couple things to think about how you can increase or decrease the net worth of your business. So we talked about the components of fixed assets, current liabilities, long-term liabilities. Well, similarly, owner's equity is going to have different categories. So here's potentially, and again, probably a little more complex, but at least we want to understand this by the end of today. The different components of owner's equity. So if a business earns more profit or loses money, from the previous slide, these are all the things that we said, what could happen. So let's look at the effects of those. If you earn more profit or you lose money, it's going to affect net profit and or retained earnings. If people give you money, or in this case, you yourself contribute money to the business, that's going to go in the owner's equity section, because we want people to know that you've put in your own cash. And let's be honest, folks, if you are running a small business, you have put in your own cash. Now, non-cash, what would that be? You could be sitting in front of it. You probably bought your computer long before you ever had a business, but you're using it for business purposes. That's actually a non-cash contribution to your business, and it should be reflected on your balance sheet. A lot of people don't think about those things, but that is true. And then lastly, the drawdowns by the owner. So again, that's going to be a negative, and we have that in there in parentheses so you can see each of those different categories of owner's equity. Now, I didn't really delve into it in this screen, so let's move on a little bit and talk about the difference from net profit and retained earnings. So net profit in that previous slide is just going to be from your most recent period. So Patty asked the question a little bit ago, is a year common? It is. So let's say we are looking at a profit and loss, a balance sheet for the end of 2019. In that retained earnings section, so I'll go back to that screen, in this retained earnings, in the net profit section, we're going to simply have whatever it was for that period, January to December. Retained earnings, on the other hand, are going to be a combination of all prior periods. So that's exactly where you're hitting it on the head, Robin, where you were saying, how long have you been in business? The longer you've been in business, ideally making a profit, your retained earnings is going to be higher. So let's look at some examples, because I'm not sure I'm driving this home yet. So if company A averages $50,000 in net profit in its first 3 years, each of those first 3 years, and then they earn $60,000 net profit in year 4. So what would the balance sheet look like at the end of year 4? Your net profit is going to be that $60,000 from right above here. Your retained earnings is going to be $150,000, $50,000 a year for 3 years. $150,000, and I apologize, my my little logo is over that figure that says retained earnings, $150,000 right there. So now let's assume the business keeps operating. Let's say in year 5, they earn a $75,000 profit. So what's the retained earnings and net profit section going to look like on the balance sheet? Your net profit is now $75,000, because again, just this period, $75,000 in profit. And what is your retained earnings going to be? It's going to be last year's retained earnings plus last year's net profit. So your retained earnings is now $210,000. So hopefully that makes sense. And people ask, well, why should we break down owner's equity? I think not even so much for you, because I think you know intuitively about your business, you know these different categories, but I think it helps people understand where your business or how your business got where it is today. And especially if you're looking at buying one of those lemonade stands, you're going to know a lot more about the profitability of a company over time. Not only are you going to see the current net profit, but you're going to see those retained earnings. You're going to see what that owner put into the business. And I have to be honest, as a lender, I definitely like to see, and I just use the term loosely, how much skin do they have in the game? How much has the owner put out of their own pocket to invest? Because the industry, and we really don't believe it's fair that a business owner should come to us, ask for $50,000 if they haven't put any of their own funds in. However, if they've already put in $25,000 or $50,000 of their own money, they've got a lot of skin in the game. And therefore, it's probably going to be much more difficult for them to walk away from a business. They're going to try really hard. And that's why we like to see people try to have some skin in the game. In other words, contributions by the owner, whether it be cash or non-cash. And the other thing that we like to see, the breakdown of owner's equity, is we like to see how owners are using their earnings, whether they're reinvesting that money, keeping it in the company, growing the cash balances, or are they taking it all out? And in this section, in the drawdown by owners, we're going to see, are you taking every penny out? And let's be honest, folks. I mean, when you're first starting your businesses, well, why do you run a business? To make money, to be able to earn money, and you want to pay yourself back. We understand that. But at a certain point in time, when there's excess, we do expect that you're not going to draw down, number one, more than the business earned in that time period. And number two, we just want to see over time that some of that money is going to stay in the business to help that business grow. So that's why we break down owner's equity. It tells such a story about your business when we can break that down into different categories. So remember our lemonade stands that had the same balance sheets, or not stands, lemonade vans that had the same balance sheets? Well, in summary, they were the same in all the summaries of all of these categories. But we've been talking about net worth. So let's, as you know, I broke down all those other categories. Let's break down net worth of both of these businesses and see if we can find any differences. So if we have competing lemonade stands, we're going to take out that point that you had made, Robin, about length of time in business. So let's say they've both been operating for 4 years and the owner works half-time. So we'll look at just the net worth portion of their balance sheet. So we know the summary is the same. They both have $10,000. Business A had net profit of $2,000. Retained earnings of $5,000. Remember, retained earnings is previous years. They've been operating for 4 years, so not too bad, but this year was a good year for them. The owner contributed $10,000 to this business, and they've taken $7,000 out. Not bad. Not bad at all. Business B, whoa, net profit of $25,000. That's a lot of lemons. I think, Patty, this person started selling popcorn because that's a lot of money. Great net profit. Retained earnings of $75,000. Again, the owner only contributed $10,000, and they've taken out $100,000. Okay, do I even have to ask which company we would buy here? I'm just going to line through it right away, you guys. That one's pretty obvious to me. They both put in the same amount of money, but the net profit is significantly different on B. What they retained in the company was massive. And the fact that they only put in $10,000 but took out $100,000, yeah, obviously we're going to go with company B. So let's do a quick balance sheet summary. As we know, balance sheet is a snapshot of a company at one moment. It helps determine the net worth. So again, think about your business. Are you getting closer now to figuring out the net worth of your business? When I think about my small business, I'm getting closer. I haven't sat here and written down the exact figures, but I'm getting closer. It helps you assess what the company owns and owes. And it shows trends over time. So back to Robin's comment, age does matter. So the longer a company's been in business, we would expect they're going to have more net worth because we would expect that they're going to have more profit. maybe investing in the company more. If you see an older company that doesn't have more assets and doesn't have more net worth, I would be concerned about that. And I think really what all these previous exercises have shown you is that the devil is in the details. If you just look at the summaries of each categories, you could make an incorrect decision on buying a new business or even analyzing your own business. Really, you need to drill down, get into some of the details on the balance sheet. And a balance sheet can help you obtain financing. Once you understand your business, you can answer questions for a potential lender. How about questions about what we have covered so far? I just saw Patty's comment. B had a great pink color also. Yeah, I agree with you, Patty. I like it because of the $100,000 in withdrawals. But so no questions that I can see. Feel free though to know your worth. Oh yeah, I like that, Patty. Again, here at CIC, we know your worth. But it's up to you to be able to help communicate that through a balance sheet. So great tagline there. I like it, Patty. All right. So those of you who were with us last week, you remember this little business called All Things Fermented. It was a producer of fermented foods, kimchi and sauerkraut. They sell wholesale, online, at farmers markets, and they've been in business for 3 years. It's kind of a side hustle for the business owner, something that she really cares about. So after 1 year of doing business, this is her balance sheet. So she's got total assets of $13,600, total liabilities of $4,550, and owner's equity of $9,050. So let's practice reading a balance sheet. So what time period is covered on this balance sheet? If you would please add into the chat for me, what time period is covered during or on this balance sheet? Okay, nobody's jumping in, but guys, it's right at the top of this one. Again, it is a point in time. It's December 31st. It's a date, not a time period. So that was a little bit of a trick question. Sorry about that. Is the balance sheet balanced? The assets are $13,600. Liabilities and equity together are $13,600. So yes, this balance sheet is in fact balanced. Okay, so Buck is asking, if I just started my business 3 months ago, would I still do a balance sheet for 2020 or only when I have been in business for a full year? I think that's a great question, Buck. You can prepare a balance sheet at any point in time. You could prepare a balance sheet today, December 9th, 2020. Just need to make sure that when you're looking at your net profit figure over here, Buck, that it is for the same time period. So let's say for that 3-month time period. I would say you should absolutely prepare a balance sheet at the end of December in 2020, if not before. If you're going for some financing, you'll probably need to do it before, but for sure, you'll do that. It'll just show up here. Your date will be December 31st, 2020. And when you go back to your income statement that we looked at last week, Buck, it's only going to show whatever time period. So you might have started in September, maybe you started in July. It'll show that on your income statement. Okay, so Pat, you bet, Buck, you're welcome. Patty asks, please explain the date to me again. December 31st, is this for the month of December or the calendar year of 2019? Actually, Patty, it's neither. It's that one day. On December 31st, what is your cash balance from the bank? What are you owed in accounts receivable? And what do you have in inventory on that day? that exact day. Because let's be honest, your cash balance in your bank account, Patty, is going to change every day. How much you are owed in accounts receivable will probably change every day, right? Does that make sense? So it's a snapshot on that one day. You with me, Patty? As of that day, that is correct. Yep. Let's keep going through here and keep firing away with the questions. I love it. It's helping us all understand this. So remember, I introduced real briefly current ratio. So what is this company's, all things fermented, what is their current ratio? So here's the hint. Current ratio is going to be current assets divided by current liabilities. Anybody have a calculator handy? They want to venture a guess. What is 3,600 divided by 2,250? We all have our phones handy. We could have done it quickly, but let's just go ahead and throw it out there for you. The answer is 1.6. Very strong. A very strong current ratio. Buck got it. Sorry, Buck. I think my computer is maybe a little slow. From the time I'm hitting it on one screen, it's taking a while to appear on the other screen. So you probably had it before I gave it to you. Current ratio is 1.6. And as a lender, I love that. It's well over 1. So that tells you they have more than enough current assets to be able to cover the liabilities that are due within a year. Let's keep going. So all things fermented, they've been in operation for more than 3 years. Did they earn more in their first 2 years on average or in their most recent year? So let's take a look here. In the first 2 years on average was $750, this retained earnings figure. So if you take that year of those first 2 years, 750 divided by 2, that's $375 a year in net profit on average. This year was $477. So our answer there, they earned more in the current year, which is great. We'd love to see that net profit's going up every year. So did everybody follow me on that? Your retained earnings, they've been in business for 2 previous years. So that's why we took that 750 divided by 2. So let's make sure we're still understanding the balance sheet. Does the net profit on the balance sheet align with the profit and loss statement? So let's take a look. And let's see. We got to check the dates because, again, we want to make sure, as Buck was talking about, and Patty as well, that the dates are good. So let's note these dates. We've got December 31st, 2019 here. Net profit is $477.20. Let me go back then to that income statement. So the time period there. Okay, again, remember, guys, an income statement is an entire period, not a point in time. So that's January through December. Net profit, $477.20. So we had $477.20 on the balance sheet right here. That was the same as the income statement. So our answer is yes. Why do we ask this? Because very often at CIC or any other financial institution, when we get financial statements, the net profit does not equal on the balance sheet what it did on the income statement. So really take a look at that, you guys, if you're preparing your financials yourself. Now, last week we talked a little bit about using some financial software. Well, that can't happen. That financial software is going to take care of that for you, but just want to make sure you know how these two statements tie together. So if you were looking for a loan, what do you think a lender might focus on all things fermented's balance sheet? Caroline, you're in the background there, and you do a lot of the lending activities at CIC with me. If you were looking at this balance sheet, what would you look at? And Patty, I see your question. I will definitely get to that because the answer is definitely yes. So I'm going to answer the first thing. Hopefully Caroline's not going to jump in with the same answer. Oh, there she said cash available. Absolutely. Liquidity is very important to a lender. So one of the things that I'm going to look at is the assets in general, the collateral that's able to be offered for the loan, plus the existing debt. So just trying to understand in general the whole balance sheet. Historical profitability. That's definitely something we're going to look at. Here it's $750. At least it's not negative. I mean, obviously there's times where if you're just starting out, that figure might be negative, but we're definitely going to look for a profitable company. Owners' contributions, as I told you before, we want to see if owners have skin in the game. So in this case, $9,750. That's a lot of skin in the game, considering the total assets are only $13,600. So they used a lot of their own cash or non-cash items to start this business. And I think the last thing I'm going to look at, again, does net profit align with the P&L? So does this 477.20 match the other statement? And Buck and Patty, to answer your question, absolutely, CIC offers assistance preparing the balance sheet. And I'm going to show you, Caroline's going to put in the link when we get to that slide, the sample balance sheet we have, how you can make it your own, and how we guide you through that process. So great question. Thank you for that. Okay, so we looked at all things fermented. It's great. We understand that. But what do we do now? Those of you who were with me last week, don't jump off. This is going to be all new information. It just looks like the same slide from last week. So yes, we want you to open your business bank account. If you weren't here last week, the reason we do that is we really need to separate business from personal. We need to know that it is truly business expenses and or business coming in and out. And then we ask that you organize the data, because it's going to be impossible to prepare either financial statement if you don't have that data organized. So just a reminder, if you were with us last week, make sure you have a separate business bank account and make sure you start organizing your data. You can do that in many different ways: envelopes, folders, copies, whatever it might be, but start gathering some things. Why? Because you need to create a chart of accounts. So how do you create a chart of accounts for assets? Well, you have to analyze your assets. What do you have? That computer, remember, even though you purchased it with personal funds, you might use it for business the most of the time. That's a business asset. So create your buckets or categories, and I'm giving you some ideas here of those categories. Excuse me. Yeah, categories, buckets, different account types for your chart of accounts. You're going to want to divide them into current versus fixed, which we went through some options, but I'll go through these real quickly as well. Cash is a current asset. Accounts receivable is current. Why? Easily converted to cash in a year. Equipment, that's fixed. To be able to sell equipment, well, but really that's not the purpose of your business. We're not looking to convert equipment to cash within a year. That's why it's a fixed asset. Real estate, if you're lucky enough to own a building, same way. Inventory, it's current. We want to turn that within a year. Vehicles, unless you're in the business of selling cars, no, that's also going to be a fixed asset. So once you figure that out, voila, you have your chart of accounts. That is your chart of accounts for assets. And again, we're recording this so you can come back at any point in time to these slides, use this. And again, Buck, we're going to show you our sample, because there's all of these things are listed in the sample balance sheet we give you. Same thing for liabilities. How do you create your chart of accounts? You analyze your liabilities. Who do you owe? How much do you owe them? Create your buckets. And here's some samples. Accounts payable, gift cards, long-term debt, current portion of long-term debt. You're probably going to need some help with that. Whoever you got a loan from, is probably going to have to tell you what the principal and interest portion of that is. That I have to be honest, folks, that's a little complicated, but it's really worth asking that, because if you ever want to borrow money, they're going to need to understand that. Again, we're going to do the same thing. We're going to divide this into current versus long-term. We'll just buzz through these quickly. Accounts payable or current. You better pay the people you owe before a year. You may not be in business. Customer prepayments, same thing. They prepay you for a service. You're going to convert that to the service within a year. Gift cards, same thing. Long-term debt, obviously. Long-term wages, you better pay your people within a year. They're not going to want to work for you anymore. And of course, current portion of long-term debt, same thing. We tell you right in the title. Again, voila. You have your chart of accounts for your liabilities. Fairly simple there. So this is, and we won't put the link up yet, Buck. We're gonna show you, but this is a sample of the balance sheet. It's going to look very similar to what you're going to find on the CIC website. You can see all the different categories here. But one of the things that I want to show you is that, again, because this is a sample of what we have on our website, it says balanced down here in the bottom, and it's in green. Now, what if your balance sheet isn't balancing? Well, if you're using, as we talked about last week, the paper and pencil method with your calculator, if you're using Excel, recall total equity equals assets minus liabilities. So you have to figure out that amount that you're off by, which is more, which is less. And then you're going to have to increase or decrease by that amount your owner's contribution, your retained earnings. Maybe you just missed something. You paid something out of a personal account, and that's why you're off. You forgot to include that. Or you're going to do the opposite. Maybe you took out an owner's draw. So here we go. Caroline is going to put in here the link, and Buck, I'll get back to your question. Caroline's going to put a link in here. This is the CIC template. It's in Excel. Please download it to your own computer. And then you're going to see all these different categories. You can change the titles. And you can see that we have tips here. And I apologize. I thought I had fixed this slide so you could see it all. But what it does show you, and that you can definitely see at the bottom, is that this is unbalanced. It's red. And what it says here is please adjust your numbers. So there's tips there. It's going to show you that you're off. So in this case, you can see total fixed assets is $49,000. Total liabilities and owner's equity is only $24,000. So you are unbalanced. You need to fix that. So Buck, if you want to cut and paste that, you can also find it on our website, cictucson.org. Okay, so here's another way to look at it. Once I'm balanced, how do I stay balanced? Because that's a big concern as well. So I want to go over some examples of changes that I make to a balance sheet and how to keep my balance sheet balanced. So let's say for my property, equipment, and vehicles, that was $30,000, but I just added to it. Just bought a new vehicle for $10,000. So I increased my assets by $10,000. So my total fixed assets are now 40. My total assets are now 60. Well, it's great. I got a new vehicle, but now my balance sheet doesn't balance. So how do I get that to balance? Well, in this case, maybe I borrowed money, or maybe I put money into the company, but If we're increasing the left side of the balance sheet or of the equation by 10,000, then we really should increase the right side by 10,000, correct? So in this case, I put the cash in myself. In my personal bank account, I had that $10,000. I put that extra $10,000 in. So the contribution by owner over here went up from 10,000 to 20,000, which now makes my total equity, owner's equity, go up to 20,000. And now my balance sheet balances. Total liability and equity equals total assets. Now we've got green for balancing. Okay, let's look at a different option. Let's say, in this case, we've got that 10,000 increasing in business credit card debt. So instead of me putting in an owner's contribution to pay for this new vehicle, I financed it on a credit card. That's realism. I'm looking at a trucking company right now, and he has absolutely bought vehicles on his business credit card. No judgment. We all do what we need to do to run our business. But this is what he had to do on his balance sheet. He had to increase his business credit card debt by 10,000, which increases the total current liabilities. By the way, I would not advocate for that. And I'll talk to you about that a little bit in financing. Now total liabilities goes up to 50,000. Total liabilities and owner's equity is both 60 and assets are 60. Now it balances. So let me step back why I don't advocate for using a credit card to buy a vehicle. We talked about a vehicle being a fixed asset. And we talked about a business credit card. Ideally, those amounts are due in a year, being a current liability. As a lending institution, we do not want to see you finance a fixed asset with a current liability. What we want to see you do is match it. A long-term liability finances a long-term asset. And I think that makes sense. I mean, most of you wouldn't be able to pay off a car or a building in a year, but I just wanted to go back to that and help you understand how we think through these things. So again, your balance sheet now balances. Okay, so let's say though now we're going to increase our fixed assets again by $10,000. So now we're up to $40,000 there. Say we're not going to finance it this time. We've got a pretty big cash balance. What about if we just pay cash? How does that affect the balance sheet? Well, right now we're unbalanced. But let's say we paid $10,000 cash. So that cash balance went from $16,000 to $6,000. So our total fixed assets, $40,000, our total current assets are now down to $10,000. And now we're balanced. So hopefully you all saw here, I could borrow money, I could contribute money to my business, or I could just pay cash. But as long as I'm adjusting the balance sheet, we're going to get this green balance down here, and we're going to be good to go. So, Buck's question, how do we find out a percentage to use for our own property, like the computer you mentioned? You know what, Buck? That is actually a question. We'll save that for Danny in the end. That is definitely more of a bookkeeper or CPA question. I do not want to misadvise you on that. And unfortunately, as you heard, Betty was not able to be with us today due to a family situation. But I do want to get that answered for you. There are going to be IRS guidelines. And I do think that Betty can address that for you. If Betty isn't able to jump on and Danny isn't able to address it, we'll get back with you directly, Buck, through the chat here. We'll get a way to get in touch with you. So I love that question because that's real life. We all need to understand that. I just do not have the professional expertise to give you the answer at this point in time. So let's move on. Once I'm balanced, how do I stay balanced? So just remember, in summary, changing one side of the balance sheet requires an additional change to the opposite side of the equation, or the reverse amount, as we did when we paid cash, to the same side of the equation. Or if we're going to get really complex, we can do a little bit of both. We can put some cash, some loans. But hopefully that makes sense to keep that balance sheet in balance, how we do that. So we created our chart of accounts for assets and liabilities. Now let's talk about how we do it for equity. Again, analyzing your equity, and man, this is tough, especially as a small business owner, to think about how much of your own funds you really put in. But that's why it's critical to have that business bank account on day one. If you didn't, you can figure it out. You can pull out your receipts, but that's part of the reason we suggest keeping everything separate, is so you can actually analyze your equity and how much you've put in. Again, you're going to create your buckets. And I will be honest with you folks, most business owners do not use all these buckets. They don't separate out their non-cash contributions. They may or may not separate out their retained earnings from their net profits, and often don't even take out their owner's draws. You guys are going to be head and shoulders above a lot of the financial statements we see, because you'll be able to go back to this slide and really think through all those categories for your own business. Voila, you have your chart of accounts for equity right here. Within this presentation, go back to it as often as you need, because we will send you the link for it. So last week we talked a little bit about tools for organizing your finances. You can use paper, pencil, and calculator. I do advocate that you start with that or some spreadsheet software, only because when you move on to some accounting software, that way you're going to understand how everything came together. So if you're using your paper and spreadsheet method, and again, folks, this is last week, we lost a lot of people once we got into the different ways to handle your own financials. Don't jump off yet, because these are going to be new things that we didn't cover within the income statement. So again, you need to create your chart of accounts. Take an inventory. You actually have to, if you're going to prepare an accurate balance sheet, go count how much raw material or how much inventory, about how many napkins and or lemons you have. You really, truly need to take an inventory, and you need to do that every time you prepare a balance sheet. Part of the reason you do that, if you have employees, is to make sure that your employees aren't stealing from you. And I'm sorry, I hate to bring this up, but it's a fact of life, and it happens. I have some friends who own 2 businesses in Flagstaff. Both of them had employee theft, and these business owners have run businesses for over 25 years. We like to believe that we trust those who we hire, but the only way you can ensure that things are not being stolen is by taking an inventory periodically. You have to sit down and determine the value of your assets and liabilities. And a reminder, on your assets, you're going to use your purchase value, whatever you paid for that asset. If possible, you're going to determine the current portion of your liabilities and, of course, of your assets. And then you're going to create, and or if you already have a balance sheet, modify it based on that information that you all pulled together. You're going to enter data for your assets and liabilities. And then, real basically, just remember, total equity equals assets minus liabilities. So, again, just a sample of what your balance sheet might look like. And don't forget, we want to separate out here your current portion of long-term debt and your long-term debt, if at all possible. So, Buck, if you use that balance sheet template that Caroline just put up here for us, here's what it's going to look like. We have in red. Please download a copy to use. Download it first. Then we're going to have all these samples in here for you. You can put the dollar amounts in, and it's got the instructions and tips there as well. So this one happens to be in Word. It's not going to add things together for you. The Excel version that Caroline presented first will be able to calculate some of those figures for you. But some of you aren't familiar with Excel or you don't love it. So there's two different versions here. And Buck, let me read your question. Would this be a Betty or Danny question? That's okay, we'll figure it out. What about trade? If I had a vehicle and I traded it for a truck that I would be using for the business. Equal trade, no loans. Wherein would I chart or record that? Well, absolutely. I think if I'm understanding your question correctly, Buck, you had a vehicle. So let's say you own that vehicle personally, Buck, and you traded it and you're now using it 100% for business purposes. That is absolutely, you're going to record that as an asset, whatever you believe the value to be. You didn't exchange any money, so maybe use Blue Book or use a realistic value. That's your asset. What do you have to do to get your balance sheet to balance? You have to put an equal figure. Well, you told me you didn't borrow any money. So on the other side of your balance sheet, that's going to be an owner's contribution. Does that make sense? And again, we can talk offline because we know, oh, good. All right, so I did all right there. So again, here's a sample. This is exactly what it's going to look like if you go to the CIC website or use the link that Caroline included for us here. So owner's equity and net worth. This is exactly what Buck was talking about. We want to determine our owner contributions, whether cash or non-cash. In your case, Buck, it was non-cash. Determine your most recent net profit. Don't you love how we think positively here? We want to believe everybody's going to be earning a net profit. It could be a net loss, folks, but you need to figure out what that is through your income statement. Determine your retained earnings. So if you're an existing business, you've been around for a period of time, you made or lost money in your last year. So we need to figure out what that figure is. Determine your owner's draws. How much did you take out of the business? We need to understand that if you're using a spreadsheet or a paper method to prepare your own balance sheet. Now, I don't get into what do you have to do if you're using accounting software. We may or may not have time to run through that today. For those of you who are interested, we can stay on. We can absolutely go through that. But even if you're using accounting software, I want each of you to understand how to do this, either on paper and pencil or with Excel. So that's why I really focused on these two today. So how do you use your balance sheet? This is something I really want each of you to focus on. It's one thing to be able to read a balance sheet. It's another thing to be able to prepare your balance sheet. But most importantly, once you do that, you guys, I want you to use it. And the way you're going to use it is you're going to analyze changes from month to month or period over period. So again, remember, Patty, this is on a given day. Will you have time to prepare a monthly balance sheet? Probably not. I'm just being real. I don't. I maybe quarterly, but probably not monthly. Annually, absolutely commit to yourself today that you're going to prepare a balance sheet annually. And here's the reason why. For those of you who were with us last week, you heard me tell this story. Danny can attest to this. Nobody expected COVID-19. Nobody expected that 2020 was going to be a year we were going to be dealing with a pandemic. Payment protection loans came out, the PPP loans. And what's the one thing that people, well, there's a lot of things, but what is one thing that people had to have to qualify for a PPP loan? They had to have current financial statements. And you would not believe the number of people that called us, that called the SBA, that went somewhere panicked. They couldn't get a PPP loan just because they didn't have their financial statements. So prepare these statements, commit to yourself that you're going to do that. And then once you get it, take a look at it. Even if you only prepare it once a year, once you get it, compare it to the last time period and what changed. Now, Buck, so you maybe only been doing this for 3 months. So you may not have prepared a business balance sheet to start with, but let's say you prepare one at the end of the year. Do one again in March and see what's changed. Why did it change? And then once you understand why it changed, What are you going to change in your business based on what you see? A great example is cash, and it's a very easy one. But let's say at the beginning, your cash was $5,000. Now it's $2,000. Why? What do you need to change in your business to get back to where you started? Or conversely, let's think positively. Your cash was $5,000 when you started. Now your cash balance is $15,000. Why? And what changes are you going to make based on what you see? Now, let's be honest. Again, we understand a balance sheet now. Your cash balance could have increased because you got a loan. So is it always a positive thing? Maybe not, but most importantly, I just want you to understand why. Why did it change, and what can you do to change your business going forward? And then the last point I always want to make, because I've been doing this for decades as a lender, is when you go to a financial institution and you ask for a loan, whether it be, Buck, you might want a newer vehicle, or somebody else, Beatrice, might want a new computer, and you might need some financing for that. Be prepared for questions from someone at the financial institution. It is always acceptable for you to say, I don't know, but I'll look into it. Don't lie. Don't make something up, because you'll always have to come back and backpedal on that. You can always say, I don't know, but I'll look into it. And then as quickly as you are able, sometimes you can figure it out in a day, sometimes it takes you a week, get back to them with the answer. But never be threatened by a good question from a banker, an accountant, a bookkeeper. If people are asking you questions, they're truly interested in your business, and they want to understand your business as well as you understand it. And if you don't know the answer to the question, just tell them you don't know, but you'll definitely check into it. So here's where I'm going to pause for questions. I think we had a lot more questions today than we did on the income statement, which is great. Why? Because it's a lot more complex. I get it, guys. This is a tough concept. We've gone pretty high level with this. There are many, many classes out there, either through Pima College, through SCORE, through the SBA, through SBDC, all different free resources where you can learn more about preparing your own financial statements. But I just wanted to give you a high-level introduction. Hopefully this helped you understand some things. I think people were asking questions as we went along. If not, please feel free to reach out either in the chat or in the question. I'm going to put our contact information up here briefly. We're going to introduce Danny. Danny's going to talk a little bit about the balance sheet presentation we made today. Now, I do want to tell you, I have some more slides ready to talk about using accounting software and show you how different accounting software would apply. We go through Wave, we go through QuickBooks. So if any of you want to stay on after the fact, I'd be more than happy to go into that. I'll just ask you to put something in the chat to say, hey, yeah, Lori, I'm interested in that. If not, we totally understand. I'm going to introduce Danny here in a moment. And then also, when Danny's done speaking, we would love for each of you to give us some feedback. Caroline's going to put in the chat a link to a survey. We really want to hear your open, honest feedback. What did you like, not like? What did I belabor too much, or what did I not cover enough for you? So if you don't mind, I'm going to end this slideshow here real quickly. We're going to get back to our crowdcast. And I need to bring in Danny. So Danny, hopefully you just got an invitation to join us. And please, we've had some issues in the past with a little bit of echo. If either of you have an echo, or any of you have an echo, please let us know in the chat. I'll just mute myself. But I'll just be quiet and let Danny run with it. Thanks for joining us, Danny.
Sure. Thanks so much, Lori. I don't know that I have a ton to add. I think you covered a lot. If there are any questions, I heard you answering questions kind of throughout. But if there are any that are left over that you'd like me to try to answer, I do think one of the things that came up with Buck's question towards the end there is how we value some of our assets. People, of course, as a business, you want to value your assets as highly as you can, but we go and sort of look at what the market would maybe pay for something. Obviously, you don't know exactly what that is until you were actually to sell off something. So in the case of what Buck was talking, like a truck, but it can be land, buildings, those types of things. I would say one of the things is we mostly focus as businesses on profit and loss, money in, money out. That's generates income, those types of things. Balance sheets are really, really important in terms, and we talk to people about, especially businesses early in their sort of life cycle, about trying to build your balance sheet. The idea of having assets is that you can then you can borrow against those assets. Most of the loans that you're going to potentially get, and most businesses actually do grow through the use of debt capital at some point, is by collateralizing and leveraging assets that you've built. So whether that's machine equipment, a building, trucks, vehicles, those types of things. But you want to think about those expenditures that you have when you're reinvesting in your business. How do I build my balance sheet? Because again, that is what you can wind up leveraging when you have other opportunities that you want to take take advantage of. And so I would, balance sheets are a little, again, they're a little more, we say they're sort of counterintuitive. They're not sort of as easy to understand as a profit and loss. Profit and loss, we most of us understand like, oh, money in, money out. I want more money in than money out. The balance sheet is a place that gives us an idea as a lender of, again, the overall value of your organization is, but also the overall health of your organization. That's where people go to look to say, okay, sure, it's great that you're profitable in a short-term period in the profit and loss, but how have you done over time? And again, although it only tells you one point in time, it does tell you, oh, well, in our organization, for instance, we are what we call about $1 million a year organization. That's the money in, money out, revenues and expenses. It's about 1.2 million. But our balance sheet is closer to $9 million. And that's really healthy in terms of what we have to be able to tap into to do our work, the assets. We own our building, for instance. We also, because we manage a loan portfolio, those are all, all the loans and the money we have are assets. And so those are things that we take time to really think about. Most business owners and good for you guys, you don't have to answer to a board of directors as a nonprofit. We do. And so I am constantly having to explain the differences between when our balance sheet changes, assets, liabilities. Those are things that they pay attention to a lot in addition to the profit and loss. And so in some ways, it's very good practice for me. I don't know that I would spend, honestly, as much time thinking about it if it wasn't the fact that I, on a regular basis, have to really look at how it is we're trying to build the value of our organization. So I hope that's sort of helpful to contextualize in some ways what it is that we use balance sheets. So what was, it looks like there's something here. How do we find out a percentage to use for our own property, like using the computer? Lori, can you explain that a little bit? Maybe contextualize that a little bit for me, a little better.
Sure. So I think what Buck was asking there, or I believe it was Buck, but it might have been Beatrice. But in that case, Danny, so let's say I owned a laptop.
Yep.
Let's say I paid $2,000 for it.
Yeah.
And then I started my business, and I now use that laptop 80% of the time for my business.
Yep.
Is that the number then? Do I take 80% of that 2,000? That's what the value of that asset is. And then on the other side of the equation, it would be my owner's contribution. Is that how I do that?
Ooh, that may be a little bit technical.
Yeah, that's why I thought too, that might really be a Betty question, and we might have to get back with Buck on that.
Yeah, and this is one of those things where, and I'm sorry to sort of, I may duck this a little bit, but in something when you're talking about what percentage of it is used for your business versus your own personal use, that is. That's a little that that starts getting into splitting hairs a little bit. In general, what we do is we have something like a laptop. Normally, what you have is a schedule of assets that are depreciable. And so that means something like a laptop, for instance, its value depreciates over time. Same with a building. And a laptop depreciates relatively quickly, actually. Most places have about a 3-year schedule for replacing technology. And so, but what most places have is they actually have a policy that says anything that we've bought over a certain amount will be considered a capital asset, and it winds up on your balance sheet, and then it gets depreciated, so it loses value each year on your balance sheet, even if you didn't do anything, because the idea again is that it's not going to be worth the same. And people are like, well, why would I want to do that? Depreciating assets are actually something when you're a for-profit. What you can do is you can write off that amount of that loss. Basically, it reduces the amount that you pay in taxes, and that's why people do that, and they keep these schedules of what their capital assets are. Again, that's getting a little bit deeper into things, but when somebody thinks to themselves, well, why would I want to put something on my balance sheet that loses value? Well, that's actually the reason, because you can wind up writing off that lost value at the end of the year against what your actual cash profit was. So that's where you need to get in a CPA. I know just enough to be a pain to CPAs to ask about those questions. But
Well, and that's why I handed it off to you, because I agree with that. I didn't really want to get into depreciation, but
Sure.
you just dove right in, Danny. So that's good. That's good. Any other closing comments that you can think of for the group?
No, I mean, I really appreciate everybody coming, and just this idea of, we understand places are at all different at different levels of sophistication, depending on where you are, how big your organization is, your business. But just trying to get as squared away as you can, and understanding both profit and loss and balance sheets are ways for you to manage your business. It is one of those things to know the value of your business, know the performance of your business, and these are the things that you may not need a loan right now, or you may not, whatever it is, that you may need. Again, as it turned out, like the PPP loans that were out there. But this is something that you want to work towards this, even if it's at a very, very basic level. And that's okay. If you run a lemonade stand, honestly, you don't need some really complicated chart of accounts, and that's totally okay. But to have some idea about these things, I think better prepares you to run your business and to succeed in business. Because the hope is you'll get bigger, and you will get more complicated as you get bigger and as you grow. And so I think getting in on the ground floor is really important in getting these things kind of squared away.
I totally agree. Well, thank you so much, Danny. Thank you to all the participants today. So I'm going to pause now and see if anyone would like to stay on. So we have Crowdcast for a total of 2 hours. So we've got about another 17 minutes or so, or 16 minutes, that I could run through why you would want to use accounting software, and maybe some examples of the different accounting software. So if anyone would like me to go back into that presentation, please just say yes in the chat, put your name in the chat. Otherwise, I'm going to thank all the rest of you for your participation today. Happy holidays. I hope that you have a wonderful 2021. We all hope things settle down, that our businesses can get back to running the way that we did. If we didn't pivot, if we did pivot. So Beatrice, I would be glad to stay on with you. If everyone else drops off, we totally understand. But again, thank you all so much. And Beatrice, and for the rest of you who are going to hang on, let's continue. So I'm going to go back then, Beatrice, and we're going to pull up the rest of this presentation. All right, so okie dokie. Thank you for hanging. And Patty, thank you so much. Appreciate your attendance today. All right, so let's talk a little bit about accounting software. Should I use accounting software? So let's talk about some pros and cons. There's no formulas or math if you're going to use accounting software. It's all built in. It's all done for you. Again, that's why I like you to do this on paper and pencil or Excel first, though, so you understand those formulas and what is being spit out at you. There are protections so you don't get out of balance. Like I said, your balance sheet is never not going to balance because the program is not going to let you move forward if it doesn't balance. So it's going to ask you what you need to change, which is great for a balance sheet because it can be a challenge. You can easily generate reports like the balance sheet. You literally will click and it will present your balance sheet for you. And accounting software is great at handling volume. Now, lastly, if you work with a bookkeeper, they're almost always going to want you to use some sort of accounting software so they can download, upload, you can talk to each other. So if you're going to move to the next level of working with someone, you're probably going to need some accounting software. Now, of course, accounting software costs money. One of the ones I'm going to show you is free for many of the services, so it might be a good place for some of you to start. There's a little bit of a learning curve, but most of them have some demos. They have some training. We list that there's a difficult initial setup, but again, I would argue that there is some pretty good training out there, and they're going to ask you questions and walk you through that. But I have to agree here that sometimes data is hard to extract if you're using accounting software. So again, using a professional, using their tech support might be something that's a little more critical to you. So there are quite a few different accounting softwares out there. Please understand we're agnostic. We are not advocating for anything in particular. These are just some examples out there. There is an article out there, and hopefully Caroline is still there, that she can add this link to our chat if you would like to go to this article. An article was done on the best accounting software for businesses in 2020. It was put out there by ZDNet. And Caroline, thank you for putting that article up there. This has been updated. The one I'm showing on the screen is from April. It has been updated in July. So go ahead for yourself. Read that article, see if something resonates with you on which that you might want to pick out. So if you're looking at different accounting software, we of course advise that you look at the features and pricing for all the different software. They're going to have a desktop version, typically browser. They're going to have app versions because maybe your business is on the go. If you're running a lemonade stand, you probably need the app. You're not going to have time to come home all the time, put in this financial information. If you can use the app on the go, might be very beneficial for you. Of course, we talked about creating your categories and chart of accounts. Accounting software is going to walk you through that. It's going to ask you questions so you can develop that chart of accounts. It will enable you to link or import your bank and credit card statements, which is a huge time savings for me in running my business. That way, I don't have to go in and enter every transaction. I can just download those things. But there's always additional transactions that you have to put in there for yourself. So Caroline put in another link for us for resources on Wave and QuickBooks. So we appreciate that. The first thing we're going to cover is Wave. It just was one of them that jumped out to us. I personally don't have a ton of experience there, but we like how the demo looked, so we wanted to share that with you. It is free for the basic plan. They have a very good invoicing and accounting system. We found it pretty easy to learn. It is a little bit of a newer program and not so common, so some of the feedback is that it's still has some bugs that need to be worked out and doesn't appear as well known. I am hearing something in the background, so I have a feeling I'm going to pause this real quickly. Or Danny, I think maybe your microphone is still on. If you don't mind just shutting off your microphone, I'd appreciate that. I think that's where I'm getting a little bit of the noise in the background. So for a chart of accounts, this is what it looks like within Wave. It's pretty cool. I mean, it on the left-hand side, you can see where the chart of accounts is. We added a Vantage West Credit Union account, and it's literally as easy as clicking on assets and add a new account. And you can input your bank accounts. It was very easy. When we clicked on add an account, it gave us the account types. There's drop downs there, so you can choose. You can name it what you want it to. In our case, we're going to use US dollars. It was very simple for us to create a new account there. So if you choose, in this case, we added vehicles. So now it shows up under property, plant, and equipment. But it's very intuitive. Chart of accounts, assets, add new account. Very easy to use. And you just repeat that process for all of your assets, liabilities, and equity. So let's say we want to enter the value of the lemonade stand. You can ignore these transactions on the left because really we're just trying to create the value right now. So we're going to have transactions. We're going to click on more. And a journal entry pops up. So we're going to click on that. We have a lemonade stand right here. We're going to put in the date of what that asset is worth. So it's going to ask us for the debits. So what is that asset worth? And right here, we're going to type in lemonade stand or trailer. Now it's going to ask us for the credits. And here we can choose any of these in here. How did we pay for this? It was an owner investment or contribution. We're simply going to choose that. Now we need to enter the value of what we paid for it. I believe in this case it was $15,000. Yep, that's what it was, $15,000. Oh, but it's unbalanced. See, I like that. I like that about Wave because it shows you I've entered the value of the asset, but not the value on the equity side, the other side of the equation. So now we have to go down, enter it here, 15,000, and our unbalanced went away. We just save it, and that's that transaction. So we entered the value of an asset. First of all, we created an account, then we entered the value of an asset. Now let's go to reports because that's why we're using this software, to speed up the time that it takes. So in reports, we have a balance sheet. We can simply click on balance sheet. You can see everything right here. Everything that we've put in, it created it for you. So I like it. You can see the transaction that we just put in. Very, very simple to use. We like Wave for that reason. Now we're cutting short on time, so I'm going to buzz through this real quickly if you guys hang with me here. So for the accounting software, we also looked at QuickBooks. We think QuickBooks is powerful, definitely universally known. If Betty was here, she would tell you that's what she knows and uses inside and out. It's easy to get bookkeeping support. They have many resources and demos. The negative of QuickBooks is it's not free. The very minimum is $12 a month, and it is a little bit harder to learn. So we wanted to show you some of the resources that they have. There is no free plan, but there's a demo account. So it's a fake business that's already set up. It happens to be a landscape business. Craig's Design and Landscape is what it would be if you went in there. And I think Caroline's still with us. She can put in how you can get into QuickBooks. It's called, they call it their test drive. So she can hopefully put that link in there for you. So again, under accounting, you can create your chart of accounts. There's the link. Thank you, Caroline. So you can see what this demo looks like. Chart of accounts is right there. This pops up. You can choose fixed assets. You can name it whatever you want. In this case, we're going to name it equipment. New is over here. It's fixed assets. Again, we can choose. There's going to be drop downs to choose what type of detail this is for our new account. Again, like I told you, we're going to call it equipment. Now we have to look at what would, again, how would we present this on the other side of the financial statement? So not so intuitive here in QuickBooks. Remember Wave? It had you put both of them on one screen. This one does not. You have to choose equity, whether it's a partner contribution. We're going to call it owner contributions non-cash because it was this equipment. It was our lemonade stand. The date. And then it's going to ask you, what was your account's balance? So that's where we're going to put in that $15,000. Again, not as intuitive as Wave, but as we know, we talked about a lot of the other benefits to using QuickBooks. So you repeat that for all your assets, liabilities, and equity. Apologize, I'm running through this so quick, Beatrice. I know we're running out of time here. We've really only got about 3 minutes before we're going to get cut off. And I'll apologize in advance if we get cut off mid-slide. You have my contact information. Reach out. I'd be glad to go through this with you in a one-on-one. This is going, oh, Robin's still here too. Thanks, Robin. So this is just in QuickBooks, how to create a new account. Excuse me, this is going to be the new journal entry. We already created the account. We're going to add the value of our lawnmower in the journal entry. Shows you right here, the account. Under machinery and equipment, that's our asset, the dollar amount in there. And then we're going to put the description in because we want to remember someday, what did we do there? Well, it says something's not quite right. Please balance debits and credits. So a little different than Wave did it, but I like it. It's still reminding us. So here we can choose. We have to know, though, that it's going to be, we need to know that it's going to be an equity account, owner's contributions. Now, QuickBooks auto-fills those. So that's kind of cool. Saves you a little bit of time in doing that. Now, lastly, reports. Same, very, very similar here. We click on reports on the left-hand side. Voila. Creates your balance sheet for you. So you can see, created that for you. Saves a lot of time over you doing it yourself. So I think I got through it. Here, that just basic information on both Wave and QuickBooks. We gave you all the links here in the chat. Feel free anytime to go back, take a look at these. You can give us a call. We gave you all of our contact information, but hopefully that just kind of gives you an introduction, those of you who stayed on, to the different accounting software. So, gosh, you guys, thank you so much again for joining us. Happy New Year to all of you. Hope everything goes really well with your businesses, and we look forward to working with you at CIC down the road. So thank you so much.